Hello students and welcome to video 1 in chapter 3.1 Introduction to Finance, and this is the only video in this chapter. So in topic 3 is finance and accounts. There are 9 chapters, 2 of them being HL, and we are doing the first chapter, which is an introduction to the topic as a whole. And as you can see, the syllabus and the learning objectives, there are really not very many of them. So this is going to be quite a short chapter. It's just a soft introduction to the topic of finance. So first off, the role of finance for business. So what exactly is finance and accounts and what do they do? Well, as it sounds, this is the part of the business which is responsible for the money, if you like. So they do a variety of things. They acquire money for the business. So they try and raise capital for the business. They manage this money. They do things such as cash flow management. They do bookkeeping, so keeping the books and the accounts. And they also do things like budgeting as well. They do lots and lots of other things as well. And within these 9 chapters, we will cover pretty much all of these. And there'll be different chapters on different parts of these. So just briefly, why do businesses need finance? Well, businesses need finance. They need money for a variety of things. They need to pay their employees. They need to buy inputs, so resources and things like that in order to produce the good or service. They may want to buy new machinery, and they also might want to do research and development, trying to discover new things, such as a new product, for example. And in this chapter, we're going to briefly classify these into 2 different types of spending. So the first type of expenditure, the first type of spending that businesses will focus on is called capital expenditure. And these are purchases of fixed assets. And these are things that they're going to buy and own, which are usually going to last more than 1 year. And when you do chapter 3.4, the balance sheet, that's going to make a little bit more sense because these will go into a different place onto the balance sheet. And so things which are going to last more than 1 year, so they invest in a new factory, then that's going to be capital expenditure. New machinery, they might buy new vehicles, whether that's construction vehicles or delivery trucks, for example. They may buy new furniture. So if it's a school, they might buy new desks or chairs or things like that. And the main purpose of capital expenditure is to drive growth in the business. So by buying a new factory, new machinery, new vehicles, that's hopefully going to mean that they become more productive or they're able to produce more things. And therefore, that will hopefully drive growth in the business. The second type of spending is called revenue expenditure. And this is your spending on the day-to-day costs of running the business. And again, these are things which the business spends money on in order to keep the business running. So what sort of things would they be? Well, utility bills, which are electricity, water, gas, etc. They're going to have to pay employee salaries. They're going to have to buy office supplies such as paper, staplers, paper clips, etc. They're probably going to have to pay rent on the property that they are in. If they own their own property, then obviously they wouldn't have to pay rent, but if they're renting from someone else, then they would. They're also going to have insurance for their business as well. And these will be paid on a regular basis. So these might be paid daily, weekly, monthly, depends on the nature of the revenue expenditure that they're spending the money on. So for example, employee salaries are usually paid monthly, not always, but usually. Rent is normally paid monthly, insurance is normally paid monthly, but then office supplies might be on a daily basis or a weekly basis, or maybe on an every 6-month basis. And these are really, really important because if you're not able to pay these revenue expenditure, these expenses here, then that's what bankruptcy is effectively. So if you're not able to pay your employees or your rent, then that doesn't automatically lead to bankruptcy, but it can certainly start that process. And if you're not able to pay those soon, then that can lead to bankruptcy. Right, like I said, that was a very, very short chapter. I'll see you next time.